Hey, everybody, welcome back to the show. We have Sebastian here with us. If you have not seen his infamous most viewed video on my channel, the full DCF analysis, hour and a half, talking all things Palantir by the numbers, leave that in the description. Definitely check that out. I'm going to leave his Sebastian's Twitter and YouTube in the description as well. Please check those out. Very, very smart guy. One of the smartest guys I know about the market. Now, a couple of days ago after earnings, Sebastian was texting me. He's in Paris right now. It was 5:40 a.m. his time, and I was doing a podcast, and he was texting me these ridiculous amounts of messages saying he cannot sleep because he's trying to figure out why Palantir reduced their Q1 guidance for 2022 and what's going on in the governmental sector. Lo and behold, he takes the next basically day to figure out what happened, and he comes up with this Twitter thread. So I'm going to share it right here, Sebastian, and you're basically going to walk us through your analysis that you've come up with.
Sounds good.
All right, so let's get into this first part in the beginning.
Yeah, so basically everybody knows Cathie Wood sold off a significant chunk of her Palantir. I think like 50%. I've seen conflicting numbers like 13.5 million, 14 million, whatever it may be. It's a significant chunk of her entire holdings. So that's obviously not good from her side. But then we have to deduce, is it going to be one or the other? Is she right or is she wrong? That's what makes the market. It's a beautiful thing about the market. Somebody's going to find out. So basically, the reasons for the sell-off, I guess if you go back up to number two, like the main reasons for the sell-off were obviously you have these huge headwinds that are affecting all high growth names that are basically like just the macro environment. It's really not good right now, specifically for the high growth names like Palantir. And I think the reason why you don't see as much media coverage on this, like the NASDAQ, what you did like in the 2000 tech bubble burst, I think this is of a similar magnitude because the index is market cap weighted, the bellwethers, the biggest of the big companies, like they're still like, they trade at low multiples, like those bellwethers. It's the high growth that was really shot. So yeah, the high growth is in the NASDAQ index, but market cap related, like market cap percentage wise, it's a chunk, but it's not like the biggest chunk as like a Cisco was back in when it was like the most valuable company in the world and everything came crashing down.
So you're saying it's not really fair, I guess, to compare Palantir to Cisco, because Cisco was valued at almost 600 billion during the dot-com bubble bust, whereas Palantir was nothing, essentially 30 billion, 40 billion.
Yeah. And I mean, I'm just talking about like the media narrative too, around like in the media narrative, like in the 2000s, it's a lot more just than like you hear about the NASDAQ crashing. It's like, I think for us, we're in a community where a lot of the names that we own are high growth names, right? And those have been shot. Versus the entire market, like the NASDAQ, I think it's down 15, 17% exactly. I don't exactly know, but like obviously during the tech bubble burst, NASDAQ fell by more than 80%. Yeah. The reason why I think you don't hear that now is because like the NASDAQ is propped up, it's a market cap weighted index, so it's propped up by some of these big bellwethers, which have relatively low multiples. So there's still like a lot of support for those major companies. That's why like even some of those major companies, even though they're down, they're not down like huge. That's why the NASDAQ itself overall is only down 15%, and you're not hearing this huge media narrative. But regardless of that, like the macro is not a favorable as a headwind for Palantir. So that's number one. Number two, like Wall Street had a huge issue with this government growth because basically in the earnings report, they're showing like sequential government growth quarter over quarter. So Q1 2021 over Q1 2020. That I can share my screen real quick. But government, you can see like Q1, Q2, Q3, Q4, like there's a sequential decline in like government business revenue growth. And so that's right, like Wall Street's main concern here. One of its main concerns is like, why is government, which is supposed to be a majority of your revenue, why is that significantly decreasing or decelerating? And that's Cathie Wood's main argument, supposedly, that the government side of the business is decelerating, like the growth is decelerating rapidly. But under the hood, I say like, I'm trying to figure out like, why would this be the case? Like, does it make sense why Palantir's government side is slowing down? Like if their TAM is like they say, I think like 56, 57 billion on the government side, they've only captured 1.6% of that TAM. They have way more room to go. Are they going to capture the whole thing 100%? Of course not. But the fact that they've only captured 1.6% and their growth is slowing, there's got to be a reason for it. Besides just like the growth is decelerating, they're topping out on the government side. There's got to be some other reason, because I think the government side has a lot more like room to go. So then returning back to the thread, I can switch this back to you. So returning back to the thread, like the third reason was that the growth guide for Q1 2022 is less than 30%. I think it's like 26%. So 26% growth is significant, is basically Q2 2022 over Q1 2021. And I'm trying to think to my head, this is like this is going into the third side of the third part of the thread, is like my concern is, so if the growth is supposed to be like going into another gear because you're hiring this massive sales team, like significantly ramping up your sales, like they closed the year with 80 salespeople.
Right.
Now they want to hire 200 salespeople additionally out of the new 1,000 people. So I'm trying to think in my head, like, okay, you're telling us you're going to hire 200 additional people and you only have 80 now, and yet you're going to decrease your guidance below the 30% threshold for the first quarter. Like that doesn't make sense. It doesn't tie out. You see what I'm saying? Like at first I'm trying to make, like, this is where I was struggling. It's like, that can't add up. So that, like, obviously a 30% growth is driven by one, government, and the other side is commercial. So then you go to the third part of the thread. So the next one. So like my concerns was what I just said, like how are you hiring more sales? The slowing. Just for Q1 2021, the guidance was below 30%. Then you have obviously the government slowdown, which is like what Wall Street is concerned about. Another reason the stock got hit. Then there's margin compression concerns, because now let's say if you're targeting your 30% revenue growth, right? Which is kind of what we talked about in like the valuation video. If you're targeting 30% revenue growth, but all of a sudden, like your like salespeople has to massively rank. Like if you're only still going to get that 30% growth that you were targeting before, that means that your margin's going to come down because you need more salespeople in order to achieve the same level of growth that you were guiding towards.
Yeah.
So your growth of the top line isn't changing. So that was my concern. It's like, how are they going to demonstrate operating leverage with this business if overall, like your revenue, like if they can think that they can get 200 salespeople and then that's going to yield 30% continuously, then obviously that's going to lead to operating leverage. But that was like where you had to dig under the hood, which we'll get into later in the thread, if that was the case. And then last, like the government client count stalled at 90. Like in Q4 2020, it was 90. And I think, I can't remember their exact customer count, but they disclosed it in their like earnings presentation. But the government business had 90 customers in Q4 2020, and it has 90 today. So nothing changed. Net gain was zero over the last year. So that was a concern. So then
quick question. The sales force of a company is not paid the most as like engineers. So like when you say they hire more salespeople and that puts a dent in their margins, is that because of the commission-based structure? Because why does more sales is just more salaries? Why do salespeople put that much of a dent in the margins? They're not like high engineers.
Exactly. Regardless if they're high-paying engineers, like Palantir is over like 2,000 employees right now. So you're gonna have overall your operating expenses go up, regardless if like they're paying them less. The number itself is going to go up, and as a percentage of revenue at first, like in the first few quarters as they're ramping sales, it's gonna go up because simply you're having the same level of revenue growth that you've guided for, but you have more employees to get the job done.
Got it.
So you're gonna bring less to the bottom line. Okay, and the next part of the thread is like, now I'm trying to quell my own concerns, like as a risk. Like these are the risks I've like identified, not risks like overall with the business, but like my concerns with the quarter and going forward and trying to mitigate these. So like taking one by one, like how can you hire all these salespeople and then still guide for in the first quarter less than 30% revenue growth? And I think it's because I feel pretty strongly about this, but I think it's because it's the nature of their business model. So they talk about all the time. They have a three-pronged business model where it's acquire, that's the first phase. Three-phase, not pronged. Acquire, that's the first phase. Expand is the second phase. They're a negative contribution margin in the acquire phase. They ramp up, they meet zero contribution margin or mainly slightly negative, slightly positive in the expand phase. And at scale, that's when the margin hits. That's when they're making the most revenue. That's when things start flowing. The acquires, like they're showing them like free demos. They're helping them like just test it out. They're not making really any revenue off of that. Right. The expand and scale phase is when the revenue really comes in. So the nature of this three-phase business model, there is a long sales cycle. That means there's a lag between by the time a customer has been identified in the pipeline and actual translation to revenue impact. So
Right.
I think what's happening is they're just now getting their sales force ramped. That sales force is not going to translate into immediate sales in the first quarter. You get what I'm saying? It's mostly going to translate probably in the back half of this year, which is something I'm definitely going to be looking for, because it's important that you're able to now ramp your sales, and then that's going to translate to revenue. I think it's just like this period where it takes time to ramp, plus those people are going to have to go through this 3-phase model before that actually is a revenue impact that we get to see.
That makes a lot of sense. Yeah, that makes a lot, because they got to get them onboarded. They got to get them to actually get ramped up and trained to be able to. And a lot of sales is relationship building, right? Like that doesn't happen in one quarter. So you're saying for the next 6 months, it is going to be lower than expected growth, particularly because of them having to get adjusted to the business. And by the second half of 2022 Q3, we'd be looking for a better growth cycle.
Yeah, exactly. It's basically this lag time that's happening right now. That's exactly right. Then turning to the government revenue growth slowdown. Like this is where I think the first one kind of seemed like off the bat, like I had an intuition this was the case. So like about the salespeople for the commercial side specifically, but on the government side, like how do I say this? Like basically on the government side, they're saying that they are following, they as in management, like this is part of like their accompanying remarks. They released this along with their like earnings report. They're saying in that accompanying remarks, like we continue to develop, like the one in the highlighted yellow, we continue to develop several large opportunities in our government pipeline, particularly in the US. Particularly in the US. And we are closely monitoring federal budget negotiations and developments around the continuing resolution deadline. So what this basically means is ever since the government, like the new fiscal year for the government starts October 1. But what they did was the Republicans and Democrats couldn't come into agreement on what the budget should be for the new year. And so they kept pushing it back. And what I mean by pushing it back is they have an existing budget, which was the prior year budget. They're just going to say, okay, let's allocate the same percentage that we had allocated for defense spending, for education, for all other sectors. We're just going to keep that same percentage. And then instead apply it to this, like kick the can down the road and just apply it to this new, like so far, like this is their like arbitrary budget for this year, just like putting in place the old budget and just carrying it forward until they can finally come into resolution of what the new budget is supposed to be. You see what I'm saying?
Can't get any money or they can't project growth if the government doesn't have defense spending officially passed.
Yeah, and I think that's why they say like we continue to develop several large opportunities in our government pipeline. And then like if you pull up like the YouTube video of the Palantir earnings call at like the 16:30 mark.
How does it get to where we want it, which was like the beginning of last year and not at the end of last year? And the way that happens is the deals were already positioned to win actually close. And so then you get into the grant.
So what does that mean right there?
They have deals. They have that reiterates what they were saying about how they have a lot of things in the pipeline. Like they have deals that they can easily win because they have these relationships already in place. They have these contracts almost already in place, but I'm not exactly sure how the structure of it works. But it, like he's saying that we have these deals in place. We're just like if you play it, and he's going to go on to say like about we have to wait for this like the new budget. So like
granularity of what will happen in the U.S. government, who gets the deals if there's no new budget. There's a lot of granularity there, which we should probably do a better job of sharing. But the short answer is it's like whose chair gets pulled first. It get the people are trying to enter the market first, last. So the new startups totally screwed because the people who are not sitting on crucial programs partially screwed. The people that have software that is or products that are useful in the past but have the right connections probably do. What's another version of this is if you just look at that chart I showed you with the CAGR on Foundry, these are the most important programs for a dangerous world. Now, can't go into all the details, but
so
we used to do.
So yeah, basically what he's saying is that they have all these things in the pipeline. They're ready to go. They just need to make sure that like this new budget resolution that's going to pass. And eventually, I think they're going to get something done, right? I mean, this is the government, and they just take a long time to get things done.
Right.
But that's what he's saying about like these new startups totally screwed because Palantir already has everything in the pipeline. They just got to make sure that like this new budget gets through. And I'm not exactly sure like what that means for new contracts or just existing contracts, but I'm sure because they've obviously reiterated it now twice in that accompanying remarks, and then again Karp saying it on the earnings call. This has a lot to do with it. And then he even said, I think.
Go ahead.
There. And he even said, like, I think we need to do a better job of doing explaining the granularity of this. Yeah, you do. But I think the reason why they don't just come out and say to investors, like, hey, investors, the reason why we're showing government growth slowdowns is because the government like can't come to a resolution. So they need to hurry up. I mean, they can't say that. The government's like more than half their business. They can't just come out and say that. But like, I think this is what he's saying. Like, we need to do a better job of like explaining the granularity of
this. So, and I'll share back in a second. The one question I have here is, and you're right, they can't say that about the government. That's why Karp can't tweet like Elon does with Senator Karen, all that stuff. The 90 customers though from the government in 2020, that not changing, is part of your hypothesis. They do have more than 90, but they haven't closed those deals, or is that not explained by this Karp remark?
That's not exactly explained, and that's not as clear. And so like later in the thread, I get into like, that was one of my 4 major concerns. That was the only of those 4, that was the only one where it's like a red flag to me. Because what did you do from Q1 to Q3? Did you not do anything? Did you not net gain any customers? Like the federal budget was in place from Q1 to Q3, but they obviously hadn't added any new customers, or their net gain was 0. Like let's say Q4 was a wash, because the government had like its own, the old federal budget deficit put in place. Let's say Q4 was a wash. Ignoring that, what happened from Q1 to Q3? And I don't think that's like clearly explained. Like, why isn't there like this government, like, why didn't the customer count go up? Now I get, like he said, like constantly, Europe there's this lag time, like 18 months, where it takes like time for, first it comes from the commercial side or the government side, and it translates to commercial, then it goes to over to Europe, and then the same cycle repeats, but it starts in like the US and then translates over to Europe. But like, I get that part. I get that Europe is slower, but why even did you not add any like new customers, like if in the US on the government side? So that's a concern. Like, I don't understand why that was the case.
Could there be a reason their sales force just allocated more of their attention to commercial? And like, that's the simple explanation, because sometimes you have to pick and choose, right? Especially if in his words, you had a nascent sales force for the majority of the year.
Yeah, like there's a stat they keep. I mean, like regardless, they just didn't execute. Like if that's the case, that could definitely be the case. I mean, they only have 80 salespeople, but the simple fact of the matter is the customer account didn't go up, so that means you didn't execute. And then I think, can you go up just like to number 7? I think. So I think, yeah. So this one is also like one thing that I thought was a little important. So on the thought of margin compression, so this goes back to the idea of, okay, you're ramping up your sales force, but yet your guidance for Q1 is less than 30%. What's happening here? If you're ramping up sales force, it should definitely translate to ramping up of revenue as well. But here's where I am getting a little bit more sense of confidence. Palantir usually guides for adjusted operating margin, which is like the video we did for the valuation, like target base case adjusted operating margin should be 30%. They typically guide each quarter, like their long-term growth target, their long-term target is to have above 35% adjusted operating margins. But each quarter they guide for like 22 to 23. And they usually, they beat that. Like this last quarter, they were at 29%. Before they were at like 33% or whatever exactly. I don't remember the exact numbers, but like it's been trending down slightly as they ramp up sales force. Like this is that idea of like there's a ramping up sales force. The margin is starting to come down slightly. But like the thought here is, if they felt like their margin was really going to be compressed in the short term, is that's going to happen? Like in the first few quarters of the Salesforce ramping, you're like undoubtedly going to have margin compression because of the fact that like the revenue impact hasn't hit yet. But for the full year 2022, they guided for 27% adjusted operating margin. And I think that, that's pretty conservative, because every time, like they usually guide for 22 to 23%. And they beat that significantly every time. But this time they didn't guide for 22 or 23%. They guided for 27%, which leads me to believe that they also think like if that's conservative, they can even hit higher than that, which is starting to make me think, okay, well, maybe there's a case that can be made that they can gain some operating leverage here because they think that sales force that they have in place, like let's say that full 200 that they're going to hire an additional to the 80 that they have now, that sales force is going to be able to drive consistent 30% your revenue growth at least year over year, which then means if you have the same number of salespeople, that's a fixed cost. That's a fixed cost. Once your revenue, like your incremental dollars, exceeds that fixed cost, like you can talk about like EBITDA, like your incremental dollars above that fixed cost. Once you reach that threshold, the rest is operating margin. Right. So they think like that's why like in the near term, margins are going to come down. Like this is what happened like with Tesla as it was ramping, like the Model 3 and the Model Y for the first time. Like the margins come down because like you have a new line, you have a new unit, but the fixed cost is like extraordinarily high, and you're only producing like a low number of units. So eventually, once you surpass that fixed cost, everything above that becomes like operating leverage. And the fixed cost is the salaries to the salespeople, right? That you're paying. Like there's the commission's obviously variable cost because they're going to make more money the more sales they do. But the salaries themselves, that's a fixed cost. You see what I'm saying?
Yes. Yes.
So that's why I think
this is the most bullish thing you saw from the earnings, is what you would say.
Their guide for 27% adjusted operating margin. They usually only guide for 22 to 23. I think they were deliberate with that. And Karp was saying like we're going to also try to get GAAP profitability to like start to equate to adjusted profitability, like adjusted EPS, and GAAP EPS are going to start to like converge, which is I think a very important thing in the long term. I don't really care about that so much short term, but like in the long term, it's important that they'll start to merge. But I think there's a lot of room for operating leverage here, and I think that was just completely missed by Wall Street, completely. And then going back to like segueing into why Wall Street sold off the stock, like the macro environment, Palantir can't do anything about that. No high growth tech stock can really do anything about that. I mean, I guess that's if they want to guide super high, and they know they can't even hit that. But anyway, that's beside the point. The second part, like the government growth decelerating. Again, I think that's because of like a misguided view that this is due to something inherent that with the government sector, like just the growth is slowing down, and this is like they're topping out. Where I think this is not like the growth is slowing down. I think like you're at this temporary lull. Like you're starting at 70+% growth quarter over quarter, or like quarter Q1 21 versus Q1 2020, and then like the growth just went like this down. And I think eventually, like in the back half of this year, once the budget gets like renewed or like a new budget gets put in place, then you're going to start to see it come back the opposite direction, which it better come back. But I mean, I'm pretty confident that it's gonna start to come back. And then the third point on like the guidance being below 30%, like if a company issues poor guidance in this market, they're getting crushed, absolutely crushed. Like Roku, for example, like issuing guidance that you just crushed the stock. So the less than 30% revenue growth for Q1 2022, I think again this is due to the negotiation of new budgets, slowing down government. And then as well as the nature of the business model, having this lag time of sales, like this lag time between ramping of salespeople to translation of increased revenue. And then like this all brings it together in terms of saying like, this I think is a lull period for Palantir, where lull is in you have a slowing government revenue as your commercial is trying to get ramped up. Your margin is going to come down. It's an ugly period. It's going to be an ugly period. Like this is not like a transition period. It's just like a lull period. Commercials ramping up, government it's temporarily slowing down, so your margin is going to come down even more, and hopefully in the back half of next year is when things are going to like really kick into the gear. You're going to get a new budget from the government. At the same time, you're going to get a sales staff that is well equipped to then ramp revenue, and now you're in that like expand in the scale phase of your business model where you're really ramping revenue with the new customers that you've gotten. Right. So and then the last point is like on 11 is like the base case, like understanding that it's like I'm still saying the 30% growth for CAGR for 10 years. Well, not 10 years, but through 2030. Nothing's changed about that. Nothing in the report made me bullish enough to say, I think it's more than 30%. nothing made me bearish, and I also at the same time to say, oh, I think it's gonna be less than 30% growth. I mean, Karp also talked about like they're starting to implement the modularity of Foundry. That was a question that was brought up on the call, and that's leading to an uptick in like the consumer business, specifically with the commercial business, specifically with the US. So that's great. That's bullish. But again, nothing leads me to believe that, okay, Palantir is going to find a way to exceed more than 30% revenue growth. And Karp came out and said, like, we have so many things in the pipeline, like we feel that there's like a lot of room to go for this business. Like if he had said something where it was like clear as day that the guidance was super conservative that they were giving, then I didn't like it. Then maybe it's warranted to raise that threshold above 30%, but there was nothing like that on the call. So then you get to like the 1.54 billion that they brought in 2021, you take that out 30% year over year, and you get to like 16 billion in 2030. Again, keeping adjusted operating margin at 30%. Like there is some bullishness in that point of them having like 27% adjusted operating margin in 22. The crazy thing is, basically like this model, like the base case model is assuming that you have 27% adjusted operating margin in 2022. And as a software business that's ramping itself, it's only going to get to 30% adjusted operating margin. Like I think that's very conservative.
Yes,
like you're only getting 300 basis points of margin improvement in over like 8 years.
Right.
Which for software business is going to demonstrate like I think a lot of operating leverage. I mean, I think it's a pretty like conservative assumption. But again, you want to make like valuation decisions based on conservative assumptions, like very base case assumptions. Tax 20%, 21%, whatever you want to call it. Then you get like an adjusted EPS because they have no debt. So they effectively like don't really have. They have operating leases, so they're gonna have some interest expense, but like that'll be netted out by interest income. So just call it like even no interest, like a net interest expense of 0. So then your adjusted EPS is like 1.57. And then Karp also said on the call, this is where something would change. Like my base case is saying that we're going to be much more in line with peers with our stock-based comp. Yep. We know that's a very big concern. So instead of going from like 2.2 billion shares outstanding, fully diluted, to like in my base case saying like they're almost at 3 billion by 2030, cutting that to 2.5 because they're being a lot less. And he even said like dilution beside the point. Like it's the dilution part just by issuance of just new shares is not even really concerned. It's like it's a non-factor. It's more of the stock-based comp that's a concern. But now that he said that they're going to make sure that it's going to be in line and checked, then I have more confidence in saying that shares outstanding, it's not going to balloon to something like 3 billion by 2030. And then putting a multiple on that, I guess you can like, obviously we looked at comps in the valuation video, you can look at like the Salesforce as well. So like I think it's like a good B2B comp. And then you get to, the price target of like 100 to 120. And again, this is just my own opinion, not financial advice, not my opinion of the firm that I work for, nothing bad. It's just what I think. But yeah, I think overall.
Can you speak real quick to before we just wrap up with Q4 earnings? Someone was commenting that 75 as a multiple is absolutely insane, or even like 65. Can you speak to a little bit of like, are you being insane assuming that, or is that reasonable?
Yeah. So that's a good question. So basically, like what we looked at was the big tech comps, like what we were like the big tech comps being like Amazon, Apple, Microsoft, Google, Facebook. I guess they're still big tech. Netflix is beside the point, but like Nvidia, like big tech, looking at that and like seeing where they typically trade, like they trade at like almost like a 2x peg. So then you have to believe that the Palantir story is not finished in 2030. Like the Palantir story has room to go versus like these big tech companies, like they're starting to come into a mature phase.
Right.
So then you have to say, okay, well, if you're going to trade it like 60 to 75 times, then effectively, if you're saying that, like, let's say in a very conservative case, right? Palantir grows its revenues in excess of 30%, 35%, whatever, in the first part of this decade. I mean, obviously 2022 is over, but like through 25, like if they grow over 30%, like 35% through 25, and then in the back half of the year, they grow like 25% each year, that's going to net to 30, right? But like your multiple is going to be based like on a forward expected growth rate. So you can say like the growth is eventually going to taper off. Like you're going to go from 35, like somewhere down the line, it's going to start to inflect into the 20s in the later half of this decade. That's a very conservative assumption, because you can then say the other way around and say, well, wait a second. If this business is hitting its prime time And this is just start, like the guy that you like that's been holding Palantir for years before like that he was on CNBC. He was like saying like he believes that this company is like in its infancy. So then if that's the case, then growth doesn't slow down. It doesn't go into the 20s. It accelerates. It starts going into the 40s consistently, like going 40s, 50s, 60s. So I think it's very conservative to say their growth is going to start coming down in the back half of this decade. Like that might not happen. The exact opposite might take place. Like they might be getting like 60% revenue growth or 50% revenue growth in the back half of this decade. But let's say their growth in a conservative case comes down into like the 20s to 25s at the back half of this decade. And then the forward projection of growth is in the 20s. Then if you apply like a 2 or 2.5 times peg, peg multiple, well, peg ratio on that, basically saying that your price to earnings relative to your growth, then you can get to it like at least a 50 times multiple, at least. So like you're saying like 20% growth forward as in the expectation. You take 2 or 2.5 times that, you're at 50 times, 2.5 times the 20, then you're at 50. And that's your peg assumption. Right. And then you can also say like you can look at other companies, like you can look like a Salesforce, you can look like a Apple or Microsoft, which trade at even higher peg, and like use those and say like maybe a 3 times peg is warranted. So 3 times 20% growth. So that's like 60 times. Like this is what these companies are being traded for today. Now then you have to ask yourself, well, do you think the multiples that those companies get are warranted? Because that's another question, because you're basing it off of like a relative comparison to what other big tech companies trade for. If those multiples aren't warranted, then yeah, okay, then it makes sense that your multiple is ridiculously high. But if you feel like the market overall judges Amazon, Microsoft, like the big tech, relatively fairly, I dare say undervalued. Like you look at Google, look at, I mean, there's many companies you can argue like one way or the other, but if you feel like they're relatively undervalued or even like fairly priced, then you can say like those are the multiples that we should just then apply to Palantir, assuming similar growth rates, and like a return on invested capital and things like that. But like I think the growth assumption that growth is going to start to decline, like percentage-wise, in the back half of this decade, is actually a very conservative one. Because if you're saying that this is a business that is in its infancy and is going to start to hit prime time, really when, like, I think there's a chance that most companies don't even realize like they need Palantir. Like even Karp was saying on the call, like first they were adversarial against IT. Now they're just trying to convince companies that like, there was value capture that they missed before. They're not going to miss capturing that again. So it's making sure that companies realize, okay, like Palantir solution is what we need. And they just don't realize like that it's available for them to just, this exists,
Can you explain what he said when he was like there was value capture that we missed? Because I was a little bit confused on that as well. What did he mean by like 7 years ago we didn't fully capture the value we should have with IT departments?
I think like this is just my best thought experiment onto what he was saying. Like I don't, I could definitely be wrong here, but I think what he was saying was that before they had a methodology where they treated like salespeople, they had a very like bad taste of salespeople. Yeah. So because of that, they said, okay, our tech's just going to win out, right? But there was other less, maybe like, not as good players in the market or like services that were being offered to these companies that they saw like these consumers were like the companies were buying these services. Mm-hmm. So they were thinking maybe he was thinking to himself like, well, why didn't we get that money? We should have totally capitalized on that. We just missed it. We were selling it the wrong way. We had the product, we had it better. We just wouldn't do a good job convincing the people that mattered that they should be using our product instead of like whatever else they went with, whether it was an internal or external solution. I think that's what he meant by we lost value. Like we didn't capture value. We're not going to make that same mistake again. Exactly. And I think that's why they're hiring some more salespeople. But like, I think the model is very conservative. It's saying that your growth is going to decline, growth percentage is going to decline. The latter half of this decade, it could very well go the other way and accelerate. And then maybe, if the growth is like at 10 to 15% in the back half of this decade, then yeah, a 50 to 75 times multiple there's no reason that can be warranted. Like, doesn't make any sense. Right. But if you still believe in the back half of this decade that they'll be in the 20% growth range at least, then at least a 50 times multiple can make sense. And that's what 50 times. What do we say? Like 1.5 in EPS.
Yeah.
Pulling that up on a calculator, like 1.5 times 50 times, $75. You know, trades at what? Let's call it 10 today. I mean, it's technically at 11, but let's call it for simple math, 10. You know, it's 7.5x right there.
Right.
So anyway, I mean, like you can apply whatever multiple you want, but like that's how I come up with that, related to big tech and see what big tech trades for, and then apply the similar multiple, assuming a similar growth rate that big tech has today.
All right. Thank you for clearing that up. A lot of people were concerned about that in comments. So like final thoughts, last minute, Q4 earnings, you thought it was good, just the market didn't react to it, and governmental slowdown hopefully in the future will ramp up if these deals go through and the federal budget passes.
Exactly. And I wouldn't say like I'm a blinded, like not calling to be blinded shareholders here. I'm just saying that like for me, like I have like things that triggers, I would say, okay, it's time to sell. Like this is where I'm wrong.
Right.
You know, like, and those are like, if the government has a new federal budget that they enact and the growth is still declining, like percentage wise, it goes from like 26 and then goes steeper down, then we got a problem.
Right.
Then Palantir has a problem with the government. They topped out. They shouldn't be topping out. There's this massive TAM they've estimated at 55, 56 billion, and they top out when they're only capturing what 2% so far, 1.6% of the TAM. You can't top out right now. So, and they're supposed to be, that TAM is supposed to be expanding too.
Yeah.
So like that would be a trigger to sell for me. Another one would probably be like that. I guess that was the biggest red flag too. Like the customer count of 90 to 90 not changing. So again, that goes back to the government side. And another red flag for me would be like if you look at the adjusted operating margin and they continuously miss. Like I'm okay with them missing the first half of this year adjusted operating margin. I mean, that's expected because again, you're in the small period. But if they miss consistently adjusted operating margin, they don't trend towards like in the back half of this year improving adjusted operating margin like towards that above that like I'm not looking for 30% right now, but as long as it is within their guidance, the adjusted operating margin of 27%, then I'm fine with that. But if it's not towards the back half of this year and the sales team has started to really ramp and as well as revenue is ramping, then I think you got like some margin problem that they have to deal with. So I mean, I'm on watch for that to just like as checkpoints for me as an investor. Like growth, I think will be there, but if growth is there but margins are coming down, it's just showing that you're having to hire more salespeople, but that's not really translating to more than 30% revenue growth, or at least like your expenses are not being offset by like a more than increasing revenue. Like if your expenses increasing, like just say very arbitrary numbers, if your expenses increasing by 5%, your revenue is increasing only by like 5, the same percentage, like you're not capturing operating leverage. You gotta be having revenue growth in excess of your like expense growth. You know what I'm saying? Yeah. So that's what I'm on watch for. But other than that, I thought it was a pretty decent quarter. Besides the 90 to 90 customer count for the government side, but I think Wall Street is right. They were quick to judge.
I think Wall Street didn't like the F-bombs. That was the other thing that happened.
I loved it. I loved that.
I loved it too. That's why I loved it.
I loved it.
I
loved the energy. I thought it was. I thought it was top notch.
I thought it was Karp.
Yeah. And it felt so interesting to see him in a suit. He's never in a suit. Whenever we see him, he looks so different, but at the same time, he still carried that same charisma.
He was in the makeup room and they were like running around trying to force him to wear the shirt. They're like, get back here, put on this thing. That was funny.
This guy's so funny. But I mean, that's him though. I think that's like what we partially place our. You have to decide, like, do you trust this guy? Do you trust this is the manager of your capital? Like, do you trust this guy? And I can sleep well saying like this guy's a genius. His view of the world is so philosophical, but yet he applies it in a way that can actually help craft that future that he's thinking of or be prepared for it. We could be wrong. We could be wrong. We have to, like, there's times where you can say like we're gonna be wrong, but Karp I think is a good leader. So
Yeah,
we'll see what happens.
I think one thing in the call too is he kept mentioning the philosophy stuff, going on those tangents, but then bringing it back to, like real numbers, and like you could see that duality playing out as he was speaking. And the other thing he said that was really important as well, he explicitly said, if you are smart enough to invest in Palantir, then you're smart enough to understand what we're doing with SBC. And when he said that, I was like, so he's kind of hinting like, we got to get rid of this to become GAAP profitable, because if we don't become GAAP profitable, the share price is not going to appreciate, because then and this whole SBC is going to be worthless at the end of the day, right? So like we've got to get to profitability, which means our interests have to be philosophically aligned with public shareholders to reduce stock-based compensation and dilution in order to reach profitability. So when he said that part, I was also like, all right, so he's trending in the right direction as well.
Yeah, and one last thing I was gonna say was I'm trying. Like I know a lot of people like here, like watch Meet Kevin. I'm trying to find a reason to figure out definitively if there's something I can point to that says like his view is wrong and this is why. Like he has a strong view and I can't figure out right now if it's like one way or the other. There's no definitive way, I think, to prove that he's either going to be like right or wrong, because the facts he brings to the table are very strong. But I'm trying to find if there's like a counter argument. I think I'm on to something, but you know, I'll share it to my Twitter feed sometime later if I can figure that out. But yeah, man, that's it.
I'll cover it when you share it. All right, Sebastian, thank you for being on. Everyone go check him out on Twitter, and yeah, we'll talk later.
I'm good. All right, see you, man. Thanks.
Bye.